Okay, so some of the extra features that we discussed is intercompany owings, means debts. Intercompany owings means intercompany debts. That's nothing but intercompany owings. So what are the things that we talking about? Owings means debts. In the case of amalgamation, there may be intercompany debts. Debtors or bills receivable of the transferee company may represent creditors and bills payable respectively of the transferor company and vice versa. In such cases, no special treatment is required in the books of the transferor company, which passes the usual closing entries. Now we are looking at what entries have to pass in the closing entries. However, in the books of the transferee means in this case Zach, after making the acquisition entries, the following additional entries needs to be passed for mutual indebtedness. Sundry creditors to sundry debtors, same. Bills payable to bills receivable, very simple. Here, transferor company are two, A and B. And here A and B were there. So when it came again, the same problem happened. Zach is a new company. That's why there was no problem. But between them also there is a problem if that happens. Same entry has to be passed. Similarly, intercompany stocks, the company stocks of the transferee, in this case, say A Limited, they may represent the goods sold by the transfer company. Transfer is here Zach, but because B is getting taken over by Zach, now Zach is actually within Zach is B Limited, sold by transfer company A Limited, come at a profit. Similarly, the stock of the transfer company may represent goods sold by the transferee company. Reverse, maybe B to A or Zach. Actually, Zach you have to look at a profit, but stock therefore includes an element of unrealized profit. There is no special treatment in the books of the transferor company, that is A Limited or B Limited for the matter. However, in the transferee company, that is Zach Limited, the usual after usual acquisition entries, the following additional entries will be passed. What you have to do, stock you have to reduce. There's no this thing about it. To the extent of the 6,000, you have to reduce the stock. But how do we do it? In the case of merger, general reserve, P&L account, P&L account debit to stock. In the case of purchase, goodwill or capital reserve to stock. So there are two different ways of handling it. Stock has to be credited. That is standard. There's no doubt about it, right? But it is, debit will be different depending on the type of purchase or merger. Okay. Some more we'll just cover that so that we can go ahead and do the problem later on, which is intercompany debentures. Now, intercompany transfer company. So say A, which is getting closed, may hold an investment of some debentures issued by the transferring company. B is the takeover company. No special treatment required in the books of A. As usual, you close it. Now what happens is that the investment account representing such holding. Now let us look at A balance sheet, B balance sheet. B. Now who's the transfer company? Trans may hold investment. So in this A's company, there is investment in debenture of B. Who is taking over? B is taking over A. The investment account representing some will be transferred to realization. So when you close the books, this is like an asset. It will be closed by transfer to realization when you close it. And usual entry is passed. After amalgamation, the transferee company B. So in the books of transferee company, they will take over the investment. It will come and sit in the balance sheet of investment. Investment in B Limited here. Because it was in the balance sheet of A, it is coming and now after takeover sitting here. But against this, there is a debenture. What is this? Debenture issued by B Limited. Now, after amalgamation, what is going to happen is there will be investment in B. From where did it come? From A Limited, because A Limited was holding the debentures. Now, what is going to happen in that scenario is Once you take over, there is investment, there is debenture, because this debenture only they were holding. Now it doesn't make sense. Now my one question that I want to ask: suppose this is 1 lakh value of debenture for this particular one. There may be total debenture issued maybe 10 lakhs, but issued to A Limited is only 1 lakh. What will be the value of investment in B Limited? This investment, how much will it be? Will it be 1 lakh? I'm again repeating. A purchased investments in debenture of B Limited some years back, right? Now B Limited is taking over the debentures of A Limited. So when it takes over, in the balance sheet of B Limited, debenture is a liability because they have issued 10 lakhs, out of which 1 lakh is being held by A Limited. When the takeover happens, this is a face value. 1 lakh is being taken over, this face value 1 lakh is being taken over by B Limited. What should be the value of the investment in B Limited? This value, will it be 1 lakh? What will be the value? Will it be 1 lakh exactly? Is my question. So that means when I square it off, I'm going to pass an entry: debenture account debit to investment. This entry, see, investment images. Once I take over, because I have to nullify it, can I pass the entry for 1 lakh? Is my question. Will it be of 1 lakh? Here also 1 lakh, or it will be different figure, Venus, and why? Will it be of same value or it will be different?
That will be different.
Why? Why? It's already given here. This will result in a profit or loss. But my question is why? Why it should have a different value? Maria, any guess? Aparna?
Redemption
Redemption. But there's
value.
no redemption here. This is not redemption. This is just brought and set squared off because there's no point in holding it in the same balance sheet, right? It is, they can hold in because it's debenture, but they will be settling it. There's no point in continuing. They don't want to continue. It is not that it is banned. Investment in own debenture is not banned, but they want to close it. But my question is whether they will be same or they will be different. My Venus is of the opinion that no, it will be different value. My question is why?
So market value.
Yeah, this was purchased at market price. This was purchased at market price when they purchased it. Though the face value was 1 lakh, this was purchased at market price. It may be 98,000, it may be 1 lakh 2,000. Don't know what is the price. That is why when you settle it, there will be a profit or a loss. Is it clear? That is why there will be a difference. Please be clear. Very simple. So when you in the books of transfer company which is holding this company A Limited, there is no problem. Normal realization entries, nothing else. When you take over, after that only you have to do some adjustments, which is that debenture account debit to investment in debenture. Because in the books of the B Limited, which is taking over, this will come and sit as an investment, and here they have issued the debenture. So this has to be nullified. How will you do it? You debit the debenture, credit the investment, but this will not match. That will show a difference. That will result in a profit or loss. Then, in the case of purchase or in the case of merger, such profit or loss will be adjusted as follows: a profit will be credited to capital reserve, loss will be debited to general reserve or P&L. It can be profit or loss. Transferee company may hold as an investment some debenture issued by the transferee company after. Now, if it is in nature of purchase, we'll come to that later. If it is the nature of purchase, it will be adjusted against goodwill or capital reserve. So these things you have to just take care. You have to remember. Otherwise, you cannot write it. It's not very complicated, but try to, though purchase given then merger, better read merger and then purchase. If it is merger, and it's a profit, credit capital reserve. If it's a loss, you debit general reserve or profit loss account. In the case of purchase, such profit loss will be adjusted with goodwill or capital reserve. Now, what is the other alternative? The other alternative is the transferee company. Here we said A limited, transferor company, B limited, transferee company. Now what is happening? A limited is having debentures, which is being held as investment in this. So what are they saying? Transferee company may hold investment, some debenture issued. After amalgamation, set of entry will be taken as the same. So now what will happen is this debenture will be taken over by B limited. Therefore now this will come as sit as an item from A limited. Again investment is there, debenture is there. Set it off, same entry, same logic. So there's nothing different. Whether A is holding the debenture in B or B is holding the debenture in A, same adjustments. Okay. So that is what we have now for the time.